Welcome to Real Estate Calculations, another episode in Tom's Next Level Exam Prep Series. I'm Tom, and I designed this series to help you pass your real estate exams, just like I've helped hundreds of my previous students. I urge you to watch my Welcome and my Exam Insights and Strategies videos to get a complete overview of this entire series. You'll learn a lot about how to get the most benefit out of these topical videos. Here's a few key points from my welcome video. We'll be in test world during these videos. I focus on the testable topics and how they'll show up on your exam. That's why these videos are intended just to be a supplement to your education provider's course materials. I certainly don't reteach the entire class, so as we go through the videos, please make a lot of notes. Make a lot of notes. They'll help you remember that information when you get to your exam. With that in mind, grab your education provider's course materials for reference, grab your notebook, grab that positive attitude you should have with you at all times, and for this video, you should also grab a little calculator, have one handy. We'll do some computations along the way in the video. Let's get started. The first document we want to review is the closing disclosure. This is going to list all of the buyer's debits and credits and the seller's debits and credits. It also is going to show the most important two numbers for each one of these parties in the transaction. What do sellers really want to know when they go to close the sale of their house? They want to know, how much money am I going to leave the closing table with? That's their bottom line on the closing disclosure. Buyers, on the other hand, have a little different outlook. They simply want to know, how much cash do I need to bring to closing to get this transaction completed? So, vastly different viewpoints. Both of those numbers are listed on the closing disclosure. Let's take a look at the seller's side first of the closing disclosure. In our example, the seller sold their house for $300,000. Do they get to keep that whole $300,000? Certainly not. They have expenses to pay out of the $300,000. But notice on the closing disclosure, and for your exam purposes, the sale price of the house is listed as a credit on the seller side of the closing disclosure. That's their big credit to begin the transaction. But they don't get to keep all of that. The closer is going to deduct the amount of $150,000 because the seller has that outstanding balance on their current mortgage. So the $150,000 will show up as a debit, and it will be taken out of the $300,000. In our example, the seller agreed to pay a 3% commission based on the sales price. Well, that's $9,000 the seller will have to pay at closing. Typically, that will come right out of the sale price. So it's another debit to the seller on the seller's side of their closing disclosure. Our seller also agreed to pay $5,000 towards this buyer's closing costs. Not unusual, not crazy in today's market. But since the seller is obligated to pay that $5,000, that also will come out of their $300,000 sale price. So what do we mean? In our instance here, the existing loan of $150,000, the real estate commission of $9,000, and the seller paying the buyer's closing costs of $5,000 are all listed as debits, and they're deducted from the seller credit, which means in our example, this seller will walk away from the closing table with $146,000 in what's called net proceeds. Okay, let's take a look at the buyer's side of this closing disclosure. The buyer obligated themselves to pay $300,000 for the house. They made the offer, the seller accepted it. So now the buyer has a big debit on their side of $300,000. That's what they're obligated to have at closing. But do they need to bring all that money in cash? No, of course not. Their lender sent over $240,000. The buyer made application for a loan, got approved. The lender is going to send $240,000 to the closing table to help offset the buyer's debit of $300,000. So here's a good point to make in your notes. This will be a test question. All new loans will always show up on the closing disclosure as a buyer credit. The buyer gets credited the $240,000 loan amount towards their obligation of $300,000. All new loans are always a buyer credit. This buyer also agreed to pay a 3% commission based on the sale price to their real estate agent at closing. So the buyer now is also obligated to pay $9,000, 3% of $300,000. That also shows up on the closing statement as a debit. It's extra money they got to pay over and above their purchase price. Also, this buyer, when they made an offer to the seller, they also included $10,000 earnest money. They sent $10,000 earnest money with their purchase offer. The seller accepted it. That money is in the listing agency's trust account, but the buyer gets credit for that $10,000. It's applied towards their purchase price. So if you look at the sheet here now, you have debits and credits for the buyer. They have a total credit amount of $250,000, but a total debit amount of $309,000. So how much money do they need to bring to the closing table? $59,000. Prorations between buyers and sellers on a closing disclosure are also very common, and you're sure to see some test questions on prorations on your exam. So let's discuss as an overview what prorations are. They're sharing of an expense, and each party should pay their fair share. Here's an example of a question you might see. No numbers yet, just an overview. Let's assume that a seller pays a utility bill at the beginning of the month, on the first of the month. But this is the month of closing. So the seller pays a utility bill at the first of the month, and closing occurs sometime during the month, and then the buyer owns the house after closing, which means the seller would have paid that utility bill for the entire time period, but didn't own the house for the entire time period. So just a logical question, should the buyer give some money to the seller at closing to cover the buyer's share of that utility bill to cover the time period the buyer owned the house? And yeah, that only makes fair sense. So take a look at this little way that I think is probably the best way for you to remember what's a debit, what's a credit. If there's a debit on your side of the balance sheet, that means you have to pay money. If there's a credit, that means you're going to get money. Now, I want to go over a quick example with you in just a minute, probably very similar to what you'll see on your exam. This is a very typical example of what you might see on your licensing exam. Any calculations you're asked to make, any numbers that they put out are going to be very simplistic, very simple numbers. They're not worried that you can do the math. They're worried about you understanding the concept and how to calculate the correct number. So let's walk through this example. A seller paid a $60 water bill in advance. Now, in advance, when did they pay it? On the first of the month. So look for that keyword in the question. The seller paid the bill in advance. Now, I want you to make a note in your book. They might say on the test question, the bill is to be paid in arrears. So make a note of that word, arrears, A-R-R-E-A-R-S. That means after the time period has passed. So a bill that's paid in advance is paid on the first of the month. A bill that gets paid in arrears is paid at the end of the month. So just bear in mind, we'll stick with our example. It's paid in advance by the seller. So the seller paid it for the whole month, but the closing is on the 10th of the month. and the seller's responsible for the day of closing. So what's the proration for this transaction? Well, I want you to take a look at the next slide. Here's the timeline for this proration. Now, before we put any numbers in here, I want you to look at the diagram, and then I want to go over this with you without any math or any numbers. I want to talk about debits and credits. So if you want to grab your notebook and sketch this out real quick, we'll be here for a couple of minutes to do this. It'll help you remember how to calculate these for the exam. What do we know about our setup? Our setup was that the seller paid the bill on the 1st of the month. And at the 10th of the month, the closing is going to occur. So who owns the house between the 1st and the 10th? Well, that's the seller. And who owns the house after the closing? Well, that's going to be the buyer. But the seller paid the bill for the entire month. So just as a logical exercise, does it make sense for the buyer to give the seller some money at closing on the 10th to cover that time period after the 10th where the buyer owns the house? And the answer is sure it does. That's the buyer's fair share. They should be responsible for their part of that bill. So if the buyer pays the bill on the 1st and they close on the 10th, we already know now that the buyer should give the seller some money at closing to cover the buyer's fair share of that bill. So if the buyer's going to give the money at closing, give some money to the seller, would that be a buyer debit or a buyer credit? That's going to be a buyer debit because the buyer has to give some money to the seller. Well, at closing, that also means then that the seller will get some money from the buyer, correct? The seller should get some of that water bill payment back. Well, if the seller's going to get money at closing, that's going to be a credit to the seller. So without putting any math here at all, and don't get too hung up, no math anxiety on these debits and credits, if the buyer's going to give money at closing to the seller, that's a debit to the buyer. But the seller's going to get some money from the buyer, so that's a credit to the seller. Now, let's go to the next slide. We'll talk about the amounts. Well, here's your step-by-step process to calculate this proration. We know the bill was $60. We're going to use 30 days in the month. They will give you that information in the exam. That means the water bill is worth $2 per day. But the closing was on the 10th, and remember the question said, the setup said, that the seller owns the date of closing. So the seller owns the property for 10 days. The buyer owns it for 20 days. So then the buyer would owe the seller for 20 days worth of the water bill, which we now know is $2 per day. So at the closing, the buyer is going to pay the seller $40 for the buyer's share of that water bill. And we already know now that if the buyer's paying, that's a debit to the buyer. And since the seller's receiving or getting money, then that would be a credit to the seller on the seller's side of the closing disclosure. So that's how this proration is going to be calculated. Watch out for that on the exam. They might even use the same numbers. Again, they're trying to keep the exam simple, not worried you can do the math, where you can do the logical progression of events here to come up with the correct number. Two more terms in calculations you'll need to know for the test: discount points and loan to value. First of all, the testable points on discount points are, why do lenders charge discount points? Correct answer is going to be to increase their yield on the loan. Simple setup. If I go to a lender and I say to the lender, I'd like to borrow money, and they tell me the interest rate is 6%, I might say to them, I don't qualify. I don't make enough money to get a 6% loan. The lender might say they can get me a loan for 5%, which would lower my payment, and now I can afford the loan, but to get a 5% loan, they'll have to charge me 2 points. Well, what's the value of 1 point? 1 point equals 1% of the loan amount. So if I'm going to borrow $100,000, they're telling me they would loan me money at 5% if I pay them 2% of the $100,000 loan, or $2,000. So I'm going to pay money up front of $2,000. Now these numbers are all fictitious, they're just out of my head, not necessarily market numbers here. But if I pay money up front, I'll get a 5% loan. So is the lender making more than 5% on that loan? Sure they are. They're getting the 5% interest rate on the loan from me, plus they're getting $2,000 up front. So they're increasing their yield on the loan that they made to me. So that's what points are. More importantly, that's how they're calculated. The other term, obviously you want to know for the test, because I've got an example question coming up after this slide. We'll work all these in together. Loan to value. Loan to value is simply expressing the loan percentage compared to the purchase price. If I get an 80% loan to value on a $100,000 house, I'm going to borrow $80,000, which is 80% of the purchase price. That's how much I can borrow. Maybe my loan to value is 50%. That means I would borrow $50,000 to get a loan for that $100,000 house. So 2 key things to remember about loan to value. These are very testable. The larger the loan to value, the smaller the down payment. If I get an 80% loan to value, how much money do I have to put down in a percentage? 20%. The reason for that is at the very bottom of the slide. Remember this for the test. Your down payment percent plus the loan to value percent will always equal 100%. So the larger the loan to value, maybe I get a 90% loan to value. What happened to my down payment? It got smaller, down to 10%. And the smaller the loan to value, then the larger the down payment. But if I get a 50% loan to value, well then I have to put 50% down. So remember, loan to value plus down payment always equals 100%. It's very common on the exam for them to combine discount points and loan to value in a test question. So here's a sample question for you. Purchase price of a house is $100,000. Buyer's going to make a 10% down payment, and the buyer's going to pay 2 discount points. So 2 questions. What's the loan to value? And how much does a buyer need to close the transaction? So let's just pause here for a second before we get into the numbers on the next slide. If the purchase price is $100,000 and they're making a 10% down payment, what's the loan to value? Loan to value is going to be 90%. 100% of the purchase price minus 10% down payment. So it's going to be $90,000. Or 90% as a loan to value, total amount $90,000. So now how much cash does the buyer need to close? Now, before we go to the next slide, just think about this logically. What do they need to close? They need their down payment plus the discount points. The down payment's pretty easy, $100,000, 10%. They'll need to put $10,000 down. Here's where students mess up on the test. They have to pay 2 discount points. Are the discount points calculated on the purchase price or the loan amount? Well, you know now it's the loan amount. So grab your calculator. Let's walk through this problem and show you how you should come up with the right answer on the exam. This is the step-by-step way you want to solve this problem if you get something similar on the exam. Purchase price was $100,000. They're going to put 10% down. That means the loan to value is 90%. 90% LTV. That answered the first question. But now how much cash do they need to close? Well, they need their down payment, which is $10,000. And with an LTV of 90%, their loan amount is $90,000. And the 2 points are going to be calculated on the loan amount. So they need their down payment of $10,000 plus 2 discount points based on the loan amount of $1,800. So the cash that this buyer needs to close for this test question is $11,800. You'll likely have to calculate somebody's monthly payment using a loan payment factor. You talked about payment factors in your required education, but a payment factor will express the amount of the monthly payment for only principal and interest, not taxes and insurance yet, but just principal and interest. And it will express that number based on the number of thousands of dollars borrowed. Pretty simply, if the borrower borrows $100,000, how many thousands are in 100,000? Well, there's 100. $250,000 borrowed. How many thousands are in 250,000? 200. It's no more complicated than that. Now, this is a typical example of what you'll likely see on the test. They'll start out with a loan payment using a payment factor and tell you the borrower borrows $100,000. 30-year interest rate, 6%. In the real world, that payment factor is $6.60 per $1,000 borrowed. So how are you going to calculate that? Well, you take $6.60 times the number of thousands of dollars that the borrower has borrowed from the lender. So what's their monthly payment? Should be no math anxiety here yet, right? This is the simple part of the computation. The borrower is going to borrow $100,000, which includes, as we said, $100,000. So 100 is the number we use. We take the 100 times the $6.60 per $1,000 borrowed, and you come up with a monthly payment for principal and interest of $660. It's just that quick and simple. They will use easy numbers for you. They won't ask you to do any exotic numbers. They will give you a chart in the exam with payment factors. You might have 3 or 4 to choose from, and you'll have to select the correct payment factor, but they'll give you the information to select it. We said this payment factor was for a 30-year loan at 6%. They might put on the exam a 15-year loan at 6%. That will have a different payment factor. So once you understand what you're looking for, the computation for the monthly payment of P&I is pretty straightforward. Here's another example of the way they might extend this question and ask you some follow-up questions. We now know the payment is $660 a month for principal and interest. Well, how can you separate those? How much is principal and how much is interest? We'll give you the simple way to walk through that calculation next. Helpful here if you want to follow along with your calculator. Oh, I should share with you. You'll always have access to a calculator when you take your exam. Likely there'll be a little drop-down menu on the computer you use that will have a calculator right on the computer screen. Or some testing centers may have little small calculators you can borrow. No memory function, no exotic calculations, but you certainly won't be able to use your phone. You won't be able to use any calculator with memory. But you'll always have access to some sort of a calculator when you're taking your exam. So let's take our loan payment of $6.60 and break out the interest and the principal. So first thing we want to try and calculate is how much of that first payment is interest. So follow me along here. The total loan amount is $100,000. The annual interest rate was 6%. So the total annual interest on that loan is $6,000. However, the buyer is going to pay that in monthly installments. So we'll take the $6,000 annual interest and divide it by 12. That means the first month's interest on that loan is $500. Well, if the interest is $500, then the balance or the difference must be the principal amount that gets paid down towards the loan balance. So we have a $660 total payment. We now know the first month is $500, which means the buyer in this case is paying $160 in their first month towards their principal amount. So $160 of that first payment goes towards principal. $500 was towards interest. You very often will see a question on assessed value and property tax calculations on your exam. So I'm going to go through the key points to watch out for on the exam. First of all, who determines the assessed value? It's determined by the county assessor. That's the correct answer to that test question. And what is the assessed value used for? It's used to calculate property taxes. So let's go through an example. This is very similar to what you might see on the test. Home has a market value of $100,000, but it's assessed at 90% of the market value for tax purposes. And the annual tax rate in this county is 2% of the assessed value. So that's the setup for the whole test question. But look at the very bottom. That's the ultimate question. What is the semi-annual tax on this property? So they're asking you for the annual tax? No, I can't tell you how many students just put the annual tax number. Remember I said in one of my other videos, in my exam insights and strategies videos, read the darn question as closely as you can. Read it 2 or 3 times. They're asking you the semi-annual tax. So this is very, very straightforward, pretty simple to compute as long as you've got the whole question in mind. You can see by now what they're going to test you on. Are you reading the question completely? They want semi-annual tax. Are you calculating the tax correctly? Are you calculating it on the market value or the assessed value? So step by step, pretty quickly, here's this one. $100,000 market value leads us to a 90% assessed value. Taxes are calculated on the assessed value, so 2% would be $1,800. Annual property tax, but that wasn't the question. What's the semi-annual tax? You're going to come up with $900 hopefully on the exam and get that question correct. I want you to think back to your required education when you talked about the 3 methods of valuation that appraisers used. One of them was the income approach, geared towards income-producing properties like apartment buildings and shopping centers. One of the calculations in that income approach was net operating income. They'll have a question or 2 on the test about the net operating income. Here's the key testable points you want to watch out for. First of all, how do you calculate the net operating income? It actually is the income after expenses. You'll start with the potential gross income and subtract operating expenses to come up with your net operating income. Now, the key testable point on this one is, in yellow at the bottom, the debt service that a landlord pays is not part of the operating expenses. I want to drill that point home now, and we have an example or 2 coming up that'll make that more clear. This is very, very similar to the example you're likely to see on an exam. So I want you to follow me here. Take a look real quick. They'll give you the numbers on the exam, and it'll be laid out pretty much like this. They'll say the annual potential gross income, in our instance, will be $24,000. That's the most a property could make. But the landlord has expenses. They'll throw in a vacancy rate of 5%. They'll throw in property taxes of $1,800 a year, management fees $3,000 a year, Debt service, $13,000 a year. Utilities, $1,600 a year. They'll give you that list of numbers and say, what's the net operating income? I can't tell you enough how many people still throw debt service when they do that calculation. Debt service is not used in the calculation for net operating income. Do not include debt service. Let's follow up. Well, here's how you want to arrive at the correct answer for that last question. Here's the numbers we had. The gross potential income is $24,000. Now, subtract from that the vacancy rate, real estate taxes, management fees, and utility bills, and you'll get a number of $16,400. They're just getting at the fact that you do not want to use the debt service number of $13,000 in your net operating income calculation. So the correct answer for that last question was, what's the net operating income? $16,400. You don't use the debt service. Well, yeah, I have to pay that. You do have to pay it as a landlord, but it's not part of the net operating income calculation. What calculation is it involved in? Oh, it's involved in the cash flow calculation. If my net operating income is $16,400, now out of my net operating income, I have to pay my debt service. I have to pay my $13,000 in monthly payments on the loan. Now, what's my cash flow? I don't have it on the slide. What would it be? It would be $16,400 minus the $13,000 debt service. So you take your net operating income. Now you want to subtract the debt service from that, and you'll come up with your cash flow, in this case of $3,400 per year. Very common that they will throw in a question on the exam about income producing properties that will involve the IRV formula, or the circle formula for investment producing properties. You went over this in your required education, but just to recap, you have net operating income, the cap rate, we'll define that in a minute, and the value of the property. This is what appraisers do. They'll take the net operating income and they'll take the cap rate, which is really just the rate of return the investor wants. And they can use that to calculate the value. Now, you're all aware that if you have a three-part formula, any three-part formula, and you know two parts, you can calculate for the third. This circle formula, to me, the beauty of it is it helps me remember when to multiply and when to divide. So on the test, they may give you this formula, or they may ask you to remember or recall the formula, but they'll give you two bits of information. They might say, here's the net operating income, and here's the value. What was the cap rate? Well, in that case, you can look at the circle formula and say, well, I need to take the net operating income and divide it by the value. That gives me the cap rate. They might give you the cap rate and the value and ask you to calculate the net operating income. In that case, you'd multiply. So you recall now, if you have two numbers on the bottom, you multiply them. If you have one number on the top and one on the bottom, you'll do some division. So that's the beauty of the circle formula. This one I remember as IRV the investor. It's used for investment properties, income producing properties. It's my little way to remember it. If you come up with a better way, use your way. But remember IRV. Talk a little bit further about the cap rate or capitalization rates. Capital is what? Capital is money. So it's the money rate. It's really the rate of return an investor wants to get on their real estate, or the rate of return they actually get. But if you just think of cap rate as the rate of return, all of you probably have some money in a savings account. Not very exciting with saving rates right now. But if you have money in a savings account, and let's say you're lucky enough to get 2 or 3% interest on your savings account deposit, that's your rate of return. You get 2% every year. That's your cap rate. That's the money that you're making on the money you've invested. So that's all the cap rate is. but they might throw a question like this on the screen on your exam. An investment property has $16,400 in net operating income. And what's the value of that property if the cap rate is 10%? Well, with the IRB formula, you can tell real quick how you want to calculate that. I want to spend a little time here so you're sure to remember this, because this investment property formula shows up on the test quite often. So in our test question, it was, with a net operating income of $16,400 and a cap rate of 10%, what's the value of the property? Well, the process for figuring out is clear based on the circle formula. You take the $16,400 and divide it by 10%. The other mistake a lot of students make is they'll hit 10 on the calculator, and then they'll enter 0.10 in the calculator and then hit the percent key. Well, that's going to give you a whole different decimal placement. So be careful how you enter those on your calculator. So here's the answer to our question. With a net operating income divided by the cap rate is going to equal the value. You do that calculation and you come up with $164,000. Now, what does that really mean in layman's terms, right? It means that a property with a $16,400 net operating income and a cap rate of 10% is worth, or appraised at in the marketplace, $164,000. That's the appraiser's approach. I'll just share this with you. The calculations are all the same, but investors use that same formula, but they'll use it in a little different way. They'll find out from a seller what's your net operating income, and then the investor will know what they want for a cap rate. They're not appraising the property. They're trying to decide if they should buy it or not. So if I know that property has a net operating income of $16,400 and I want a 10% rate of return, that's what I dearly want, then I know what I should pay for the property. Or an investor might say, no, I need a 12% or a 15% rate of return, and that will change the value. Well, that concludes this episode of Calculations and Math. I hope you enjoyed it. I hope you got some good information out of my video. Take a look at the other list here of the other national exam topical videos that are out there. If you want to brush up or refresh yourself on any of those topics prior to your exam, please take advantage of my free videos out there. Thanks for watching. I really appreciate you taking the time to watch the video. Stay positive and stay focused. As always, if you like my videos, please click the icon below. If you want to subscribe to my video series, I will stay in touch with you and let you know when I have new releases coming out. I'm also going to be doing my career prep series and my skills and stories series, and I'll let you know when those are available. Feel free to comment. I would love it if you would, and then share the videos with anybody else you might know who's in the process of taking their real estate exams. Thank you.